Okay, let's talk about it. The one number that trips up almost everyone in investing, from total beginners to people who've been doing this for decades. It's the PE ratio. And it's probably the most powerful and, the most dangerously misunderstood number in the entire world of finance. Just look at this quote for a second. High PE isn't bad. Low PE isn't good. If you can really, truly get your head around why this is true, really let it sink in, it will fundamentally change the way you look at the stock market forever. I promise you. Welcome to Everything You Need to Know About Finance. Now, just a quick heads up, this is a deep dive. It's for your understanding. It's not financial advice. And hey, if you appreciate this kind of straightforward deep dive, a quick like and subscribe really helps us out a ton. Okay, let's get into it. We are going to completely dismantle this myth that the PE ratio is just some simple price tag on a company. It's so much more than that. So on the surface, it's dead simple, right? Price divided by earnings. It answers one basic question. For every $1 of profit a company makes in a year, how many dollars am I, the investor, willing to pay right now to own a piece of it? So a PE of 10, that means you pay $10 for that $1 of profit. A PE of 40, you're paying 40. Simple. But this is where most people stop thinking. And that, my friends, is the big mistake.
So, if it's not just a price tag, what is this number actually whispering to you? What's the hidden message behind that number 10 or 40 or, sometimes even 100?
And here it is. This is the absolute key. A PE ratio is not a verdict. It is not a stamp that says cheap or expensive. It is a story. It's the market's collective bet, its collective belief about a company's future, all wrapped up nice and neat in a single number. So let's unpack that story, starting with the low PE stocks. When you see a single-digit PE, you have to put on your detective hat. Are you looking at a genuine bargain that everyone else is just ignoring? Or is it a trap, just waiting to spring on you? On one hand, the appeal is obvious. This is classic value investing, right? You get what they call a margin of safety, because so much bad news is already baked into the price. It's way easier for a company that everyone hates to actually deliver a positive surprise. But, and this is a big but, the danger is very, very real. That low PE could be a massive warning sign that earnings are about to fall off a cliff, or even worse, that the entire business is on its last legs. You see this story play out in specific sectors all the time. Mature, cyclical, or just slow growth industries. Think big banks, major energy companies, utilities. They often trade at low PEs simply because the market's expectations for any kind of explosive future growth, they just aren't there. Now, let's flip the script entirely. Let's look at the other end of the spectrum, the wild world of high PE stocks. Here, the story is all about optimism, innovation, and yeah, sometimes it's a pure gamble. The appeal here is the hunt for the next big thing, the home run. You're paying a huge premium, not for today's profits, but for the enormous profits you believe are just around the corner. These can be incredible wealth compounding machines. The danger, that belief is incredibly fragile. If that growth even hints at slowing down, these stocks can get absolutely crushed. The drops can be just brutal because the whole valuation was built on a story of perfection. And again, you see this in specific areas. Think about all the excitement around AI stocks today. Companies in tech, biotech, and software, they often have these sky-high PE ratios because the entire narrative is about scalability and future potential. The profits they make today are almost an afterthought. It's all about pouring every penny back in to dominate the future. This brings us to a really crucial point. This is the idea that connects both of those worlds. A company with a PE of, say, 50, that's growing its earnings by 40% a year, can actually be a better bargain than a company with a PE of 8 that has zero growth. How? Because that growth stock is rapidly growing into its valuation. The denominator is catching up to the numerator, fast. This means that using the PE ratio all by itself is like trying to build a house with only a hammer. It's a useful tool, for sure, but you need a full toolkit to see the whole picture. So let's build that toolkit right now. Okay, now look at this, because this is where that idea really comes to life. It's called the PEG ratio. All it is the PE divided by the growth rate. So look at stock A. Its high PE of 40 is perfectly matched by its 40% growth. That gives it a PEG of 1.0. Now look at stock B. It looks cheap, right? PE of 12. But with only 5% growth, its PEG is 2.4. So on a growth-adjusted basis, you could argue that stock A is actually the cheaper stock here. This is exactly why the PE is just the start. You need a checklist. First, are the earnings even real? Are they high quality or are they playing accounting games? Second, is the company generating actual cash or just paper profits? Third, how much debt are they carrying? And finally, what's their return on invested capital, or ROIC? That's just a fancy way of asking, how good is this company at turning $1 into more dollars? It is a killer metric for quality. So let's put all this together. It's not about being a value investor or a growth investor. It's not about joining a team. It's about developing a new, flexible mindset to understand the story that the market is trying to tell you. You can use this as a kind of mental map. Low PE strategies, they tend to work better when the economy is uncertain or when interest rates are high, a lot like the environment we've seen recently. High PE stories, on the other hand, need a strong belief in the long term, a really durable competitive advantage, and, frankly, an investor who won't panic during the inevitable ups and downs. It's all about matching the story to the environment. This is the big shift. This is the whole point. Stop making statements like, oh, a PE of 12 is cheap. Start asking questions. Why is it 12? What is the market so afraid of? And for that high PE stock, why is it 50? What incredible future is the market pricing in today? And this right here, this is the question that separates the amateurs from the pros. For that cheap stock, what happens if the thing the market fears actually comes true? And for the expensive one, what if that incredible growth slows from 40% to 20%? Understanding what breaks your investment story, that is the ultimate form of risk management. So let's end with our new rule, the one that replaces that old broken myth we started with. The PE ratio is not a final answer. It is not a buy signal or a sell signal. It is simply the start of a very, very important conversation. By learning to ask these questions, you move beyond just simple numbers, and you start to understand the real stories, the real human emotions of fear and greed that are driving the market. Where that conversation takes you, well, that's up to you. If you enjoyed this analysis, be sure to check out our other episodes to keep